Hi, I'm Ruth McCambridge of the new nonprofit Financial Commons, and I want to welcome you all to our very timely, as it happens, webinar on nonprofit borrowing or debt capital. The nonprofit Financial Commons is designed to be a resource platform where nonprofits both teachers and learners, and where they're seen as being the most knowledgeable among those who are sharing information on nonprofit financial management. Just a quick nod to our troubled operating environment. We know that you may have concerns and even direct experience with the ripples from the recent failure of two banking and lending institutions. There are some implications of that the panelists will address, but overall this seminar is more broadly focused on the what, when, who, and hows of nonprofit borrowing in general. In other words, this session is a tour through the current landscape of debt capital that is, as of now, relatively underutilized by a lot of nonprofits. Taking us on this tour today are two of the nation's most knowledgeable experts on the topic, and that is it's no exaggeration. Kate Barr of Propel Nonprofits and Dana Lieberman of IFF in Illinois both have many years of direct lending to nonprofits under their belts. They've also done a lot of innovating in that space. Joining them is Dana Brito as today's moderator, who has the same kind of direct hands-on experience in lending to nonprofits. You will find her in the question and answer area at the bottom of your screen, not the chat section, but the question and answer area, where we urge you to ask all of your questions early and often during the webinar. She'll be looking at those questions and sorting them for the panelists later on, but you can also questions that you'd like us to take up, potentially even at a later date. Joining her is Mark Hager and Wade Rogers, who are both moderators with the nonprofit Financial Commons, and they will be answering some questions that might be quickly answered on the question and answer area, but they also will be keeping an eye out for interesting topics that we might want to bring forward. Finally, we are very grateful to two nonprofit leaders with recent borrowing experience, and those are Martin Ludden of the St. Paul Neighborhood Network and Vina Iyer of the Immigrant Law Center of Minnesota. And thank you very much for joining us and sharing all of your experience with this. Back to the question and answer area, use it really freely and enthusiastically. The surfacing of your questions in this section will feed into topics we take up in the future at the nonprofit Financial Commons. So please tell us exactly what is on your mind, what you'd like to be able to talk about here from now on. That said, this is a reminder that this 90-minute webinar is sponsored by MIP Fund Accounting. They provide adaptable cloud-based accounting software for nonprofit, which scales nicely with your organization's growth. MIP offers accounting functionality, including general ledger, AR, AP, budgeting, and grant reporting, along with integrated payroll and HR. We are enormously grateful for MIP for bringing this resource to you for free, and we hope that you'll check them out. I will tell you that the last 30 minutes of this webinar, we find that sometimes people schedule in an hour and they don't stay for the last 30 minutes. It's always a small group, but there's always a group. But I want to let you know that that last 30-minute actually contains a lot of useful nuts and bolts information. So make sure, if you can, that you stay all the way through. With that, over to you, Kate Barr.
Moderators and my fellow panel members. So I'm going to give you kind of a really quick overview of some really fundamental information about why we refer to this as debt capital. We are talking about loans, but we're talking about loans because they are a really productive part of how nonprofits can operate. So let me offer a 5-minute tour of the concept of capital and nonprofits and why it matters. So I'm going to present first just the idea that the nonprofit business model, when we think about business models of nonprofits, we often focus on what revenue you have. And revenue, of course, is key, right? It is the lifeblood of how you actually pay for things. But the revenue that you have is only one component of the actual machine that makes the organization work as an economic entity. There's the revenue. So I say that there are these 4 interlocking components: the revenue mix that you have, the cost to deliver the programs that you do, the infrastructure that you build for the organization, and then the capital that you have that underlies it all and supports it. So I offer that just kind of as a baseline as we then talk about debt capital and capital in general. So when we talk about capital, though, I first want to just make the distinction between revenue, the money you bring in every year, you spend it to pay people, to pay for expenses, to pay programs. If revenue flows through the organization, is used to spend and pay for the things that you do to be effective in your community. That's revenue. That's not capital. That's revenue. Let's talk about capital, though. And I want to acknowledge, too, that nonprofits have multiple kinds of capital. Today, we're going to be talking really about the financial capital, the capital that comes with a dollar sign. But let's also acknowledge that one of the things that makes nonprofits unique and important in their community is the social capital that they have, the networks of relationships, the cultural capital that you have, and the way that you understand your community and relate and are really often of community. And then the symbolic, the prestige, the recognition, the reputation that you have. These are all the multiple forms of capital. But today we're going to talk about financial capital. So what is it that financial capital does for you? Revenue pays the bills. Capital, because if you think about revenue flows through. Capital is sticky. When you think about capital as sticky, one of the things that buys for you is stability, flexibility, the ability to be resilient and to change and to be adaptable, and then durability. So these are some of the characteristics of organizations that are what we would call well capitalized. And so if you long for stability, flexibility, resilience, adaptability, and durability, capital is probably going to be part of how you're going to find those. So let's talk again very specifically about financial capital. And I'm going to make this distinction because when we talk about actually how loans or debt capital can be productive, it's helpful to think about there's working capital. This is usually cash. The cash that you have in the bank or accounts receivable. And there are really kind of 3 flavors of working capital, not the technical term, flavors. There's the cash flow, right? The money that you have, and you may have some pretty typical cash cycles in your organization where you get funds in and you get funds out, and it probably has peaks and valleys to it. So that kind of normal cash cycle that your organization has, if you have sufficient working capital, cash flow capital, you're stable. Executive directors sleep. You're able to really kind of function well if you have that adequate cash flow. Operating reserves gives you that kind of flexibility and stability that if something goes wrong, if something doesn't happen when you expect it to, if you have an unexpected expense or delay, those operating reserves kind of undergird that. Opportunity capital, change capital, is cash that you have that you get to choose to use to invest in some change to the organization. You want to grow a program. You want to seed fund a new revenue source. You want to try and innovate and try something new. Or sometimes you want to recover from something unexpected or something negative that happened, a big deficit or something. And that's opportunity or change capital. So these kinds of capital are working capital. The second kind of capital is this long-term capital that's not liquid, that usually is in a longer-term form. Often it's real estate, like a building, or funds that you've invested in leasehold improvements in your property that you're going to be in for a while, major equipment, investments like that are long-term, or endowments or long-term investment capital. So long-term capital, it doesn't have that same liquidity, but it has a real durability effect for the organization. So these definitions of capital are helpful when we think about how we might use debt capital as one form. So what kind of capital do nonprofits need? And not all nonprofits, whether you have a budget of $15,000 or $15 million, need working capital, need cash flow. You just have to have cash flow. Most nonprofits need to have some amount of operating reserves because things don't always happen when you exactly want them to. Some kind of ability to make some changes or to get ahead of yourself or to invest in some change. And usually there's some amount of fixed assets, even if it's your computer network. Some nonprofits then also really appropriately are going to own a building, have long-term fixed assets like leasehold improvements. And some organizations, not most, frankly, are really well served with an endowment. So if you're thinking about capital and you want to think of it in what order to think about it, start at the top. Working capital is always the first. So where does capital come from? And in a way, there are three ways to think about it. You either have capital already. And the way that you have capital already, actually, you look at your balance sheet and say, do I have some unrestricted net assets that are liquid? Or do I have some unrestricted net assets? That's our capital. So we own that capital. Generally, where that comes from is surpluses over time. We had more revenue than expenses. We had some surpluses, and we kept it. And that's how you build up some of that internal owned capital. The second place that capital comes from is contributed. And this is the classic capital campaign. We often the classic capital campaign is for building or for facilities or something long-term, but there are also more and more organizations are doing capital campaigns for change capital, investment campaigns, growth campaigns, that kind of camp. So we can have contributed capital. And then the third kind of capital is debt capital. We can borrow it either for working capital or we can borrow it for long-term capital. So these are the three ways that we can get capital into our organization. So if we think about debt capital, when is debt capital productive? I think that when you just think about the four definitions that I just gave you about capital, working capital, is debt capital ever a useful form of working capital? If you have a line of credit, you have borrowed debt capital. And it can be really useful. If you think about an organization, if you have a $2 million budget for your organization and you have a few $100,000 in your own cash, you have accumulated some cash, that's probably serving as your main buffer for working capital. But there may be times where you have delays, you have a particular grant cycle where it comes later in the year, where you may have some need to have some additional cash. That's where working capital can be really useful. Debt capital can be really useful for working capital. Lines of credit, short-term bridge loans, things like that. What about for change capital? You want to invest in something for the future for your organization. This is one where I'd be more cautious. Potentially, for change capital for growth, debt capital can be useful if you really can confidently predict and project where revenue will come in. What about for recovery from a deficit? You've had a big deficit. You think, let's borrow some money, we'll pay it back over time, and we'll replenish. It is possible to do that, but that's one where I would be quite cautious about it. Just because sometimes it's a matter of you just dug your hole a little bit deeper rather than getting ahead of yourself. So it's possible, but needs to be really carefully planned. For fixed assets, debt capital can be incredibly productive for buying a building, for making investments in leasehold improvements, for improving your property, because it's a long-term asset that you're going to pay for over a longer term through debt. And then for long-term capital, endowments and long-term investments, using debt at that point is a very sophisticated financial exercise that really requires a lot of analysis and financial strategy that is often outside of most of our scopes. So I would be it's much rarer there. So again, that's my quick tour through capital and debt capital, because we really want to talk more about reality. What's it really like in the field? And we're going to start by asking you how you use debt, whether or not you have experience using debt capital, and what's been your experience. So I'm gonna stop sharing. Did I stop?
I'm going to launch the poll now.
Thanks, Amanda. So have you used debt capital in your organization at all? And if you have, which of these types have you? A wide variety of experiences, either using or not using loans as part of your capital for the organization. Just another minute or two, and then we'll share the results. Amanda, I think we can share. Yeah, go ahead.
It is
So
not
again,
sharing, you can see.
So wide variety of results. Quite a few people here have used lines of credit. Quite a few have used some kind of loans for buildings or for capital campaign bridge loans. And then about over 40% haven't used loans. So a wide variety of great experiences that I'm sure we could all learn from. Thanks, Amanda. I think we can stop sharing that.
All set.
Okay, thanks, Amanda. So now what I'm really excited to do is to actually share some examples of some real life using loans in action. And that's where my colleagues Dana Lieberman, Martin Ludden, and Vina Iyer are going to help with sharing some experiences that they've had and that they've seen. But I'm going to start with an experience from Propel Nonprofits, which is a loan fund, a nonprofit loan fund based in Minnesota, about a line of credit. Working with a community clinic. When you think about a community clinic, their sources of revenue, and this is typical in healthcare, is a combination of insurance companies paying, public insurance programs coming from Medicare, Medicaid paying, grants from foundations or grants from state agencies, in particularly in Minnesota Department of Health, and then individual contributions. So they have these different types of revenue that tend to often have a pretty long cycle to them. If you've ever operated with an insurance company or gotten paid by a third party or by a state agency, you know that there's often a lag of 30, 60, 90 days to get paid. And so the cash flow for this clinic, when you think about a clinic is heavily people-based. 80% of their expenses are personnel. They want to pay their payroll really regularly. They know they're going to have to wait to get their payments from state agencies and insurance companies. So that line of credit is fairly large because the possibility is that that cash flow could be, they may need up to $500,000 and they may need nothing. And so a line of credit is helpful for them to be able to access so that they can confidently have that stability of that working capital. So line of credit is probably the simplest and most understandable and really attractive form of loans. So that's a pretty straightforward example that I think you can probably understand. Next, we want to talk about using loans for long-term assets. And so Martin and Dana Lieberman, I'm going to invite you to kind of unmute and talk about the example at SPNN.
Martin, tell them what you did.
All right. Hey, I'm Martin Ludden. I'm the executive director here at St. Paul Neighborhood Network in St. Paul, Minnesota.
And just before I started in 2015, the organization was located downtown St. Paul, and the landlord opted to increase rent significantly on a short turnaround in a way that was not sustainable for the org. So we had to move quickly, and we had to move quickly in a way where we didn't have time to do a capital campaign. So the org located a site that needed significant build out. It's where we are now. And we were able to do that build out because of a significant loan from IFF and Propel. And it was a situation where we weren't going to get a bank loan on that. There wasn't an entity that was going to lend a nonprofit the kind of funds that we needed. And then on the backside of that, it also, and this was a huge boost for me coming in as a new ED, there was also service on the backside of that loan in the form of kind of a consulting CFO to help us make sure that we were staying on track and making payments and continuing to be sustainable.
Yeah, and I'll just add that in this situation, which is not uncommon with nonprofits, lease space makes the most sense, but it doesn't mean that you don't need to invest in that space to make it optimally usable for you. So that takes a lot of money. It takes a lot of capital. It's for a long-term use. You would expect that if you're going to invest capital, you would have a long-term lease so that you know you're going to have the ability to use that space for a long period of time. And so long-term capital does make sense to pay for this over time so that the revenues that you're bringing in weekly, monthly, annually can pay for that space over time. What is challenging, you said a bank would not do this, you know, there's all different types of situations, but what is unique about a lease space versus owned space is the collateral, and we'll get to this later in the presentation. There's not a lot of plan B repayment sources in lease space. So most lenders are going to look to the cash flow of the organization to repay the loan. And with the lease, there isn't, the organization doesn't own the building. So there is not that plan B. So that's where a CDFI lending opportunity made a lot of sense and worked really great. And it's worked well for you, Martin, and it's worked great for Kate and me as well.
Yeah, and there's a couple good points on that. Like, we're a community media center, so one of the things we had to build out is a TV studio. So when you talk about kind of significant build out expenses, and also we're here in a 10-year lease on a 10-year loan term, so that all makes sense for us, and it was a great fit.
Yeah, I think particularly one of the things I think that's really important, and you said it earlier, Martin, was you had to do this fast. And so the ability, that's one of the things about loans that is different than fundraising, is that they have a different timeline to them.
Yeah, and I mean, so like you said, a capital campaign is, that's years in the making. Grant funding, and we do get some really nice institutional support here in the Twin Cities, but those aren't cycles that you can kind of hit in a predictable need-based timeline. You have to find the application and do it and wait for it to get reviewed. Whereas with a loan, you can do that and be up and moving. Like I said, I think we had 6 or 8 weeks to get out. And so we had to find a spot and start building on it quick.
Yeah. Well, thanks, Martin and Dana. And by the way, put your Q&A in, because after we do our 4 cases, we're going to pause and ask all of your questions that I'm sure that you'll have for our panel members here. But next I'm going to turn to a really different example, which is using loans, using debt capital for growth, for that change capital, that opportunity capital, where we're looking ahead to where this organization is going. We know that there's some investment needed in order to make that kind of change. And you don't always have that cash available yourself. When is it appropriate, and how can you use a loan to really propel that growth forward? So I'm happy to have Vina Iyer from Immigrant Law Center of Minnesota here to share an example from them. So welcome, Vina. What do you do? Tell us what you did.
Thanks so much. And thanks so much to to Kate for having me here. As Kate mentioned, I'm the Executive Director of the Immigrant Law Center of Minnesota. To provide you with a little bit of context, our organization is a legal aid organization. We provide free legal services to the community here in Minnesota, a little bit in North Dakota as well. From a budget perspective, we are an organization that grew very, very fast in the last decade. And honestly, particularly between, frankly, the beginning of the Trump administration in 2016 to 2020, with just an enormous amount, outpouring of generosity from our community, to the point where we had grown to pretty quickly from being in like maybe like a 1.5, $1.7 million budget to more like a 2.2, $2.3 million budget pretty quickly over that 4 or 5 year period. I wasn't the executive director there. Then I became the executive director and actually just joined the organization from the outside in 2020. In 2019, so right before the pandemic. So that just, I think, gives a little bit of stage just to help you guys understand where we were at. So as an organization, we just got through the pandemic, and we're just really thankful for PPP loans and employee retention credit, everything that both helped us to keep being able to going on mission, keeping everybody employed, and frankly ended up with us being at Bank with a lot of organizations too, strangely in a really good financial and cash position, which we continue to today. And we knew as an organization that in order to get to the next level, that we really needed to invest more in our development function. So that's something that we had been thinking about and talking a lot about in 2020 and early 2021. And it was something that I talked a lot with my board about, my finance committee about. Everybody was very much on board with that. So I think, frankly, we had, I think, the cash to be able to invest in that function and had some long-term strategy, even without the loan, I think. But I was in a financial leadership training with Kate and with Propel, and I'd gotten emails because we're in Minnesota from Propel about the different products that they had available. And I came across this recovery capital loan, and I was like, what's this? Let me read this. And it was like a loan of up to $300,000 with $75,000 being forgivable, a low 3% interest rate to help your organization grow after the pandemic. And the first thing I think I thought to myself is, oh my gosh, is this too good to be true? This seems pretty darn amazing. And my second thought was, well, we don't necessarily need it, but wait a minute, there's a $75,000 forgiveness. So isn't this, it's not quite free money, but it's very close. So I thought, okay, this is something that we should dig into. So really at first it was me and our director of finance and operations and our accounting firm that dug in just to see a little bit about it. And everybody thought, hey, this makes sense. Talked a little bit to my finance chair, who is, thank goodness, he is very, very sophisticated from a larger organization where they've used debt to fund lots of different things. So he was like, start to explore it. This makes sense. So I reached out to the Propel team, and they were fantastic in both understanding what the loan would do, what we would need to qualify. And we went through the process and were able to very, it honestly was, they made it so easy and made it very, very easy to go through the process and get everything. And so when we presented it to our finance committee and our board, we had very much kind of socialized everybody to this idea. And frankly, I think that the main question we got, and I think was absolutely the right question, was my finance committee chair said, so we want to invest in this, and we think we probably could invest in this with what we have, but we're really doing this in large part because of the forgiveness, and it makes a lot of sense. It is a financially beneficial loan for us. And I was like, yep, that's right. And so I think we were in a lucky position where we could have done this with maybe without the loan, but it made it a lot easier. And I think that there's if I were, I think, in this position and we weren't even in as good of a cash position when we were, I think if we had a good vision for what we were going to do with the development director and what they would be able to do for the organization, I would have felt comfortable going after this loan as well. But we got the loan. It was fantastic. We got it in early 2021, hired our development director in April of 2021. She has hit the ground running, has done an amazing job. Last year, we had our highest level of individual giving. We are set to have some really great returns, I think, this year on individual giving as well as grants, because she's just been able to bring a great level of data analysis, other things to the process, and it's been really fantastic. So I feel like it's come out so far the way that we wanted it to. And on the payment side, it's been pretty easy. It was interest only for, it was no payments were due for the first 6 months, interest only for 7 to 12 months, and then the total loan term is 6 years. Right now, we're in a position where I think we're going to pay it out over the whole loan term. And partly it's because interest rates are really high, and I just put a lot of money in a CD today. And so that's also very different for our organization. We hadn't been doing it, and we're getting a better return on the CD than the interest rate on this loan. So for right now, that's what we're planning, but we're really excited about it. So.
Such great financial analysis, Vina.
And all because of Kate and financial leadership for
well,
nonprofit. It's
right,
so
yeah.
true. It's so true.
Yeah.
Yes.
Thank you, Vina. That's great. Well, I think that the example that you have, which is whether or not you had the cash or not, the using a loan to invest in something that will generate revenue in the future, and it could be development. It's often something that social enterprise type nonprofits have used, both the product you're describing, but also just a term loan, because they know that they can invest in. I know at Propel, we have worked with some social enterprises that do recycling type services, and buying a new piece of equipment that lets them be more efficient generates revenue in the future, but it takes a lot of cash because it's a big upfront. And so that kind of upfront investment that really builds for the future. I'll just mention here, and then we'll talk about it more in the Q&A. This is the kind of ways that small businesses use debt capital. And this is one of the places where this kind of odd bifurcation that has happened in many people's mind, that nonprofits and businesses are different. This is where nonprofits are businesses. They always have been. And there's no reason not to use the same kind of tools like loans to really build an organization forward. So thanks, Vina. So again, put your Q&A in and we'll get back to that. But I'm going to turn back to Dana Lieberman and ask her to talk about one of the other pretty useful forms of loans, is when you just need to bridge some money. There's a bridge period, often, especially if you're doing a capital campaign or some other kind of large fundraising. So Dana, why don't you share an example?
Sure. Yeah, and I was looking for the emojis or something to put up there, because I wanted to double down and smile and thumbs up when you were saying why do nonprofits sometimes we get in our own heads about this. So anyway, thumbs up, smiley face to what you were saying. And I should have done just a little bit more of an intro. So I'm Dana Lieberman. I'm the Chief Lending Officer at IFF, which is a community development financial institution. I saw some of that go on in the chat. And I'm based in Chicago, but we cover the whole Midwest as far as our lending. And we do a lot of bridge lending to nonprofits for lots of different purposes. Most of our bridge loans are bridging capital campaigns. And basically, I'll give an example. We worked with a social service agency based in Cincinnati that works with various supports for teenage mothers, and they had expanded and were ready to buy a building. They had embarked, and the building required some renovations as well. They had embarked on a capital campaign. They had a $900,000 capital campaign. They had raised in pledges $840,000. But as many of you might know who have embarked on capital campaigns, this money comes in over time, right? Sometimes it's 2 years, sometimes it's 3 years, sometimes it's certain milestones. And let me tell you that the contractors and the sellers will not wait 3 years for you to pay them. So the choices would be that you wait for all that money to come in and wait 3 years to do your project, or you find some way to bridge the actual receipt of that cash and move forward with your project and pay it off over time. So how we structure our bridge loans, and we did a $900,000 bridge loan for this organization, is they went ahead and bought their building and started their renovation with a loan from us. They had some other capital that they had cash on hand for. And we structured it such that when it was an interest-only loan for 2 years, because that matched with their pledge schedule, we would go up to 3 years. And as these proceeds come in over time, they would pay down the loan. And so at the end of the 3 years, the whole loan would be paid down, and they would be debt free on the building. So that's just, it's one way. They knew this was an organization that actually did not have the capacity to take on long-term debt. Their revenues didn't support long-term debt. They were raising money, but they didn't want to wait 3 years to embark on the project. And as some of you know, sometimes raising money can be spurred by actually seeing the project in action too. So we have gotten very comfortable with certain things being in place to be able to bridge these types of what we think are very solid cash flows coming in. That bridge can be applied to different things as well. So it could be some kind of tax credit or a TIF. We've seen a lot of recovery funds coming through that are on a reimbursable basis. That's really annoying for nonprofits that don't have the cash on hand to be able to do the work to be reimbursed. So if we feel good and you feel good about money coming in, and it's just a timing difference, that's when these bridge loans come in really handy.
And Vina also for these examples, because hopefully what you're getting from this is these real life examples of how nonprofits are really smartly making these sorts of decisions. But now we really want to turn to your questions, and Dana Brito, maybe you can join us now and talk about, take us through some of the questions that are coming in, and we can respond to them and see what conversation we get going.
Yeah, sure thing. We have a lot of questions, but I think we're getting a lot of questions typically from, I guess, for organizations that are newer or maybe don't have or have pretty limited credit history. I think the first question is more around for those organizations in particular, are there specific loan facilities or vehicles that they should be looking towards? And then I think the second part of that question is more around the application process, or like what type of cash flow analysis should you be prepared for, what type of information. So again, for newer organizations with limited credit history, we'd love to hear the panel's thoughts on how to go about that and what to be prepared for.
Dana, you want to take that?
Sure. So admittedly, a startup is hard to lend money to. And I think you as a startup would say it's hard to borrow money as a startup, because you don't have as much certainty on your cash flows. But I'll just say at IFF, if you have been in business for 2 years, we will evaluate if you have the cash flows to be able to support debt. And that's what's really important is debt has to be a tool that is positive and not bring more uncertainty to your business. So at least I would say in the CDFI world, at least the CDFIs that we typically work with, like establishing credit and a credit history, it's not the same way of going about it as maybe you would in a personal situation. So it's really a pretty deep dive into your business. And it's like, do you have some certainty into your revenue streams and your cash flow coming in? And if you do, if this is the first time you're borrowing, that's fine. We are not necessarily looking to see if you paid something back before or if you've been late on credit card payments. It's more like we care more about the future. We're going to look to the past as an indication of what the future would be, but we're not looking to, we're not like, you're not getting a credit score spit out like you would as an individual. So I'd say a credit history is a little bit different. And Kate, I know we're going to get into like how do you access capital and application a little bit, so I don't want to go too far into it.
Yeah, we have some slides coming up really, so it's a little bit more the nuts and bolts, as Ruth was talking about lending and being prepared for a loan and what to expect. I know that there were a couple of questions too about, especially after Vina talked so beautifully about Propel. Propel is a regional organization in Minnesota and the surrounding states. I wish there was a Propel in every single one of your communities. And when Dana and I will talk a little bit more about where you can get loans, and particularly community development financial institutions, or CDFIs, which are a mission-based, community-based lender, which is something unique and really valuable to know about.
So if we do have time for another question, I think, again, there's many, but I think understandably, and I think this might be impacted by what's happening with the financial or the bank crisis on the West Coast. I think people are curious about rates, which again, I think can be hard to anticipate or think about, but maybe if we bring out our crystal balls or think back to prior, crises, any thoughts or indications around what we might expect or what's happening right now as it relates to rates? And again, certainly may vary depending on the lender or the type of loan you're looking for, but any and all thoughts or predictions I think would be welcome here.
Well, if only I knew, I'd be rich, but I mean, even before the bank collapse, we've been in a rising interest rate environment over the past year, and that's been for the first time in 10 years, right? Like we've basically had very steady flat rates for a very long time. Rates are going up. So that is across the board. The cost of capital to borrow is up. Now, again, I'm not an economist or a fiscal policy wonk or anything, but I mean, the goal of raising these rates is to curb inflation, or that's some part of that. So hopefully at some point, the cost of things will come down a little bit as the rates go up. That hasn't quite happened. I mean, it's starting to happen. But at this point in time, a large capital project is going to cost more than it did 5 years ago. I mean, and there's a lot of reasons for that. It's the supply chain issues, it's the labor, and now it's interest rates as well. So from the little that I can understand, it doesn't seem like that's going to change anytime soon. Like rates are not going to go down. They're not going to keep going up and as steep of a curve as it has over the past 6 to 8 months. But the days of 3% rates are probably over for a bit of time. So that's sort of the reality of fiscal monetary policy, I guess. I'm not really sure, nor do I think anyone knows how this recent crisis with a couple of banks might impact the broader financial sector. I don't, and we were talking a little bit about this, I don't see this at this point being like the 2008 crisis. This seems like very isolated. But I suppose time will tell. Yeah,
I would agree, Dana, and I would reinforce that I wouldn't even call it a banking crisis. I would say there was a very, very targeted, specific problem with a couple of banks that I don't think that any of us should get alarmed about. I will tell you, FDIC insurance is a beautiful thing, and that's actually what you should probably pay the most attention to, is having your deposits be insured. But in terms of interest rates, I think also just to respond, we have actually been in an unusually low period of interest rates for several years, and now we're into a different kind of a market. And when you're thinking about borrowing, whether it is, especially if it's for a longer term, like a mortgage or a building, you really have to focus particularly on the cash. How much are you gonna have to pay every month, and can you accommodate that interest, that loan payment? That's going to be the determining factor rather than the rates. And anytime that we try and kind of, say, well, we're going to wait for the rates and see if we time it to work for your organization. If you need to start construction on a building, start construction on the building. And if you can afford the payments, afford the payments. That's really the thing that's going to determine it. I mean, the SPNN loan, you got it when rates were kind of more like what they are now, and have been making the payments, and the payments worked for you. The fact that the payments got lower after, but actually the loan was originally probably at about the same rates that we're at right now.
I think we're at 6%. So wherever that tracks with where we are now. Yeah.
Any other questions, Dana Brittle? Because we could probably do at least one more right now.
Yeah, I think we have a few questions along the lines of cash flow. So I think there was a question that came up, I think, when Martin was speaking. So maybe a little bit about sort of his experience and the type of cash flow that was going about when he was accessing credit. But even more specifically, what do we mean when we say cash flow? Are we talking about earned income, or fundraising or maybe other types of capital. So I think what we mean when we're saying cash flow, and then any of the experience, particularly from the organizations who have experience applying for it, what did that look like, feel like, I think would be helpful.
I wasn't here when we did the kind of the initial analysis to get this loan, but I will say, as we're considering some additional possibilities for borrowing, I mean, cash flow is, you know, separate from your budget or your financial statements. It's your money in and out. Like, are you bringing in enough money month to month to pay the bills and make payroll? And can you project that out a year, 2 years to make sure that you know? And I think for when it was introduced to me, this is a great way to identify if you need a line of credit, because you can see out 6 months. I might have a bump here where I'm going to have trouble making payroll. Then I can get a line of credit in advance and take care of that. But so that's what we're looking at when we evaluate now is if we take our, you know, fixed expenses that we know we're going to pay every month, we project out our revenue on a monthly basis best we can. Do we have the liquid resources to pay our bills and make payments on a loan? And thank you also to Propel's nonprofit leadership cohort for teaching me all about that.
And this is the sort of thing I will now say that the Financial Commons is going to have this kind of resources, this kind of training available. We already have some resources. If cash flow is something that you think would be worth paying attention to, it is. And cash flow projections are probably the most useful financial tool for most nonprofit leaders. So there are a number of different samples and examples and templates available, including some through the Financial Commons. And I really encourage you to learn how to use them.
And I think, and maybe this is transferred over to the Financial Commons, but there's a great template on Propel's website, and I will share that in the chat for y'all, that cash flow document. I don't know if it was Vina or Kate that said that's what makes sure the executive director can sleep at night. It's a huge help.
Well, why don't we now turn and go back? I'm going to share slides again, and we're going to go through some of these nuts and bolts of borrowing. And then we'll have time for some more questions, because we may actually cover some of what your questions are here. So let's talk about where to get a loan and how to get a loan and what to expect if you're talking about loans. So where to access debt capital? So sources of loans, probably not a surprise to you, is first on the list is commercial banks. This is what banks do. And by commercial banks, I mean the bank in your town. It could be a community bank. It could be a mid-sized regional bank. It could be a large bank. The kind of the noise that we're hearing right now in the banking sector, I think that we really have to understand that the banking industry is a big industry. There are a lot of different kinds of banks, and there are reasons to have community banks, mid-sized banks, regional banks, and big banks. Again, FDIC insurance is what I will say. But banks are obviously the number one place. They are generally available to most of you. Some of them may be local, where you know the banker or where you walk into the branch. Others of them, it's going to be online. But banks may or may not really have a good understanding of nonprofits, of your particular kind of nonprofit, and of your community. So, but banks are a good place to start. And you may in fact have contacts at banks, right? You may have a banker on your board. You may have you probably have a bank account. And so one place to start is the banks. There are some public programs that may be local in your state. They may be regional. SBA, the Small Business Administration program, is unfortunately not generally available to nonprofits, but there are sometimes some special programs, but particularly through maybe your state economic development agency or your city agencies or your city business development. There are specialized lenders, particularly if you're in a field like healthcare, long-term care, senior care. There are often some specialized lenders. And leasing is actually a form of borrowing. So if you are leasing technology equipment, copiers, that's actually a form of borrowing. But there are also mission-based lenders that may be really a great fit for you if you have access to one, and if there's one that is kind of fits within your sphere. Social purpose loan funds, and then specifically CDFIs, Community Development Financial Institutions. Propel is a CDFI, IFF is a CDFI. There are hundreds of them around the country. I think that someone put a link to a CDFI finder in the chat, or in the Q&A, but we'll make sure you get it. I wish there were more CDFIs that specifically looked at nonprofits. Dana, my guess is that you agree with me. There are a handful, though. IFF does, what, 10 states in the Midwest? IFF is available in 10 states in the Midwest. There's Nonprofit Finance Fund based in New York that has offices several places in the country, and there are other regional CDFIs. And then foundations are actually sometimes a source of loans. Foundations, usually when they're making loans, they do it in the form of something called a program-related investment, or a PRI, which is a very specific IRS term. But basically what it is a foundation can use some of their funds to make a loan, usually at a below market interest rate, usually pretty preferential. It is a loan, though. They do expect to get paid back, but often then it could be a source of some funds if a foundation with whom you have a relationship is interested in offering PRIs. It's worth a conversation. PRIs can be especially helpful for things like Capital Campaign Bridge or Capital Campaign Startup or something like that. Not every foundation offers that kind of financing, but some do. Some do, and it's of great interest to many foundations. So how to find a lender? But then once you've identified, or once you're interested in maybe talking to a bank or talking to a CDFI or talking to a foundation, here are some things to think about. What a lender is looking for. So Dana, could you maybe share some thoughts about this one?
Sure. I had referenced earlier on the leasehold that, there's not collateral, but really what we are looking for is how you're going to repay your loan, right? Like, we don't want you to take out debt that doesn't feel comfortable for you and that it's going to be stressful for you to pay. We want to know in conversation with you that you have a plan to repay the loan, and that it fits into your cash flow analysis, right? Like, these are the things you pay for every month. It's salaries and expenses, it's rent, and it's your principal and interest on your loans. So really that is where a lender is going to spend the most time with you. It's like understanding your historical financial picture and understanding your budget for the coming year, and how does taking on this debt and the expense of debt, debt has an expense to it, and how that will fit into your operation. So that will be, from my standpoint, 90% of what the conversation is going to be about. And really what we're looking for you all is to understand that, right? It would not be good for anybody personally or at your organization to take on debt and not understand what are the requirements and the responsibilities of that debt. So if you're looking at that cash flow worksheet and don't know the answers or don't know the fillables or whatever, like, that's the work you start to do now, to think about, how do I understand and how can I tell my story so that I go in making the case that this makes sense for our organization and we'll be able to pay it back. So that's 90%. And then the contingency plan is, sometimes things just don't go according to plan, right? Like, there's a pandemic, or there's a grant that gets unexpectedly not renewed. So, is there a plan B, or is there some cushion, or is it, if everything doesn't go exactly according to plan, the whole thing blows up? That's a stressful way to live, right? That's a stressful way to go to sleep at night. Even a line of credit's not going to make you feel super good about that, right? So I think it's understanding like what you expect to happen, and understanding what amount of cushion you have in case something doesn't go according to plan, which often happens. And there's a lot of conversations about your management team and your board of directors, right? Like, what are the competencies and capabilities and experience that you all bring to this that kind of backs up all these plans that you have? So that's pretty much, that's it in a nutshell. There's a lot more details to it, but it's being able to tell your story is really important.
Yeah, thanks, Dana. And I love that because, on this slide, it talks about always, always, always. A lender wants to know about how you're going to repay it, kind of what is your kind of plan B, or kind of how are you managing contingencies? And then how can you tell the story of how you are well managed, how you are really a well-run organization, which nonprofits are. Nonprofits are well run. And so then the things that I put on the slide in that kind of often and sometimes, I think that these maybe rise to the top more, like, oh, collateral is really what it's about. Collateral is secondary. Cash flow is first. And so, but knowing if you do need, I mean, if it is for a building, what is the building? Where is it? Do you own it? Or do you have, equipment? And then if it's a niche lender of any kind, like a nonprofit lender or like a lender that is looking for housing or healthcare or any other or regional. And then sometimes a lender is going to be interested specifically in your some kind of impact measures or some kind of specific ownership structure or really truly a triple bottom line, which is something that like a social purpose lender is often interested in. So, but always primarily it's that how does the repayment happen? So loan terms that we're thinking about, these are the sorts of things to be prepared to talk about. How duration of the loan matches the use of the funds. So anything else? What would you add from all of these terms, Dana?
Yeah, no, I mean, duration is important, right? If you have a 3-year loan, and then you have to come up either and just like get some terms out there. And I'd be happy to, we also have the ABCs of kind of lending on our website that I can put out. But amortization means how much of the loan you pay each year, basically, right? So if you have a $100,000 loan and it's a 10-year loan, you pay $10,000 a year, right? But sometimes you have what's called a balloon, and that's on there, which means that maybe the maturity is in 2 years. And that means after 2 years, you have this big excess payment, the rest of the loan that comes due. Well, that means that basically in a year and a half, you're already thinking about like, what are we going to do with this balance? If either do I have to pay it back or do I have to refinance and start all over again and talk to a lender? So thinking about, how long do you have the certainty of this capital, or is this something I'm going to have to like figure out how to repay more quickly than I'm going to have the money to do it? So I think the repayment terms is really, really important. People focus so much. Everybody, it's natural. It's the easiest thing to understand is on rate. It's like, oh, 6% is better than 7%, or 6% is better than 6.1%. It is. There's a lot of other costs in all these other terms that you have to dig into a little bit more, but can really be the difference between a loan structure that works for you and a loan structure that doesn't work for you.
Yeah, that's a really good point. When you think about everything that's on this slide, in fact, because we'll be sending you the slides after the session today. This may be a good slide if you're thinking about or discussing internally about having a loan, is just to think about all of these, because I'll take you all the way to that other terms. What kind of information you're entering into a relationship with this lender, and how are you going to maintain this relationship? So what kind of financial reports do they expect? What kind of ongoing information? Are there any covenants which are requirements? So for example, if a covenant is, if you have a deficit, all of a sudden you have a problem. I mean, you can't predict if something is going to happen, and timing, especially with nonprofit accounting, right? Some timing thing happens. So just understand those are. And then that last one, the prepayment fee, for some loans, especially long-term loans, some lenders will say, if you want to pay us off early, you have to pay us a fee. So you just have to be aware of that and make sure you're factoring all of these things in. The other thing on here I want to point out is just the guarantee question, because here is one of the places where nonprofits and private businesses are very different. Private businesses, owners of businesses, especially, when they own the business, they guarantee the loan. It's their asset. Nonprofits, if you as the executive director are expected to guarantee the loan, or if your board members are expected to guarantee the loan, yeah, Dana Lieberman and I are like, boo, boo. But banks are really used to guarantees. This is the way they lend to small businesses. And so the idea that you don't have guarantees is often something that really requires a discussion. And I would be sure to have that discussion, and not just to say, well, one of our board members willing to guarantee. I would really hope that you could change that discussion and talk about the how well managed the organization is, well led the organization is, how you've done the cash analysis and are able to pay it back without a guarantee. So And then one of the other kind of bread and butter things is, how do you prepare? So now you're ready, you want to go talk about a loan, you're going to go to your bank, you're going to go to a CDFI. Here are the things that you really need to have prepared in advance. First of all, is that the the leadership of the organization, if that's the executive director of finance, CFO, board treasurer, board, everyone has to agree this is a useful tool for us to use. Because sometimes, I know we've had this experience at Propel, my guess is you have at IFF, the leadership of an organization, the staff leadership understands, they've done the analysis, they're like, this is a great idea. And then there's a brick wall that comes up at the board, often because of some myths about the use of debt capital for nonprofits. So that's a conversation to make sure you're having in advance. And then who's going to be involved from the organization in this conversation? And then be prepared, as Dana said, to tell your story, to have your finances, to have your financial report, but also to be able to talk about how the organization works. What are your revenue sources? What is your cash flow? Where do you get the confidence that you have it? And then really have that analysis. But remember, you're the experts in your organization, not the banker, not the CDFI. You're the expert. So do that analysis yourself. And then be prepared to discuss what you think the needs are, how you see it. And this is a place where often the conversation can be really productive, because you may in your own mind think, well, here, what we really need is that we need 2 years where we're not going to make any payments. Well, that's not actually a loan term that's available. So there's a productive discussion that could happen there. But be prepared to know what you think you need and what the repayments are. So anything you'd add to that, Dana?
No, the only thing I would add as far as, I mean, I wholeheartedly emphasize, you know your story better than anybody else. So make sure you can tell it the right way. And don't be afraid, and certainly don't hide things that didn't go well, right? Things don't go well all the time. So if there's something in your financials that looks wonky, someone's going to ask you about it, right? If your revenues went down 50% last year, that you can't hide it. You shouldn't try to hide it. You should have the answer and explain why a lender should be totally comfortable with that, because the next year it went up and you got your contract renewed for 5 years. And so we're good to go. But thinking like sweeping things under the rug is not the way to go. Being as transparent and comprehensive in your explanation, I have found to be a much better approach to moving things forward.
Yeah, I'd actually even say that the fact that you navigated through some difficulty demonstrates the leadership quality.
Agreed.
To tell that story. Yeah. Yeah. So here are just some lessons learned from many years of both that we know from organizations we've worked with and from us as lenders, is that kind of readiness, like that you've actually done the preparation, you're ready organizationally, you think that this is a good idea. You've done that internal work to make that decision and to really be prepared for it, that you found the right lender. And I realize that sometimes this takes some work to look around and find a lender that's really going to be a good fit for you. That you match the loan purpose with the structure. So if you have, again, as Dana was talking about, a loan with a 2-year balloon, if you have a need that's actually a 10-year need, try and find a way to get as close to that as you can in the loan structure. And then know that it may take some complications. There may be some navigation around things like a guarantee or some of these other questions that come up. And then really think about this as a relationship, because you might have a very transactional relationship with some lenders. The leasing company, I don't even know the name of our leasing company and we lease our laptops. That's not a relationship, that's a transaction. But I have relationships, with SPNN and Immigrant Law Center and different organizations that Propel has used. So think about if it's a relationship or transaction. And then be aware that borrowing is not risk-free, right? Nothing is, but there is a risk that something will happen and there could be a problem, and we may have to work that through and work with the lender on. And it kind of, this is, again, back on that relationship. Is it transactional or is it really a relationship? And understanding each other, understanding what their goals are, what they want. Banks are interested in deposits. And so if you are working with a commercial bank and you have some deposits, FDIC insured, of course, they'd like them. And so understand that you also are bringing something to this. Borrowing money from a bank isn't you're not on the bad side of the relationship. That's a positive, but banks want other relationships. They're really interested in working with you, and just understand all the terms. And again, the no surprises rule that we all would like to have with our employees and our board members, your bank wants it too, or your lender wants it too. There are a couple of things that I'd like to, and then we're going to go back and do some more Q&A because I see there are a lot of questions, which is wonderful. I do want to talk though about kind of some really important big picture realities about using debt capital. One is some faulty norms. There are some kind of, I think they're myths, but there are some norms that have been set in the sector or that have been set in the environment that we are dealing with and that we have to really kind of push against. One is that nonprofits shouldn't budget for surpluses, right? Nonprofit means you should end with zero every year. We all know that that's a faulty norm, because sticky capital, the kind that you own and have yourself, is wonderful. And that this is actually the thing that gives you stability, flexibility, and resilience. The faulty norm that nonprofits shouldn't have much cash. Also, very related, faulty norm. Nonprofits can't have nice things. So if you are looking to build out leasehold or lease a space or buy a building or improve a building, there's kind of this mythology that nonprofits, that the leaky roof and the crinkly chair and the falling off arm is what nonprofits should have. Your facility, your equipment, you're doing such important work in the community, and having a beautiful space that really supports that mission and conveys that in the community is really a part of that mission or part of those relationships you have with your clients. The community clinic I talked about for the line of credit just recently built a new building, and they did a huge amount of design with their users and with their patients and with their community. And the space is magnificent. And you like feel healthier just walking in the door. That is mission.
Yeah, I'd
And-
also add to that, Kate,
yeah.
it's for your employees and your staff too,
Mhm,
right?
mhm,
I mean,
yeah.
like staff retention and recruiting is so hard right now.
Mhm,
It's not just about salaries. It's like, these people work really hard.
Mhm.
Why should they not have a good workspace and a lunchroom and a
Yep.
nice desk and a chair that's not from Goodwill? I
And
mean, nothing wrong with being
a,
frugal.
a computer that works. Yeah.
Exactly.
Yeah. A TV studio that actually functions all the time, every day, 7 days a week. Yeah. And then the last one is that nonprofits shouldn't take on debt. And this is one that I guarantee you will run into, and you will run into it with board members, with probably staff members, and even with bankers. And this is that one where nonprofits are businesses. Businesses use debt as a really productive form of capital, and nonprofits can too. Not badly, not in a way that's not helpful, but in a really productive, helpful way. And then some environmental factors that I think we just have to be aware of as environmental problems and have to kind of collectively own and really work to counter these. One of them is the perception that nonprofits are risky or not well managed. So, well, how can that bank make a loan to a nonprofit? You know, nonprofits are so risky. I will tell you, I was a banker for a long time, and we made loans to startup restaurants. Give me Immigrant Law Center, Minnesota, any old day over that. So bank policies don't consider nonprofit business models, and this is true. It's that nonprofits have a very different business. Our accounting is different. It's hard to understand, requires deciphering, and there is some education required often about how are state grants reliable? How are grants and foundations reliable? How are individual donations reliable? So we have to talk about that. And there's absolutely bias and racism in financial systems, in banking policies. And this is something that I know that we at Propel, I know IFF, we're all working on. And one of the things that CDFIs, frankly, are able to do is that we're able to have a different approach to our policies. Dana, you've done some amazing work at IFF around your loan policies and things like real estate. You want to talk about some of that?
Sure. So one thing that's unique about IFF and Propel as well, and actually very few other CDFIs, so it's nice to be able to say this, is that we are not appraisal based, and we're trying to get away from saying that because no one knows what it means. And what it means, so a reality is that traditional financial institutions like banks are regulated. And so they have a lot of things that they have to do in essence to protect their depositors. And so one of those things, and you can argue the right or wrong of it, there's a lot wrong with it, is that they require appraisals, and they will only lend you money up to a certain amount of the appraised value of the facility. So it's typically like 80% of the value. That would not be so bad, except there's so many problems with the appraisal system and the bias in the system, and also just the value of real estate and the reality of disinvestment in communities is so tied to generations of racism. So appraised value is going to inherently be much lower in certain disinvested communities, often communities that have nonprofits that are either serving people of color or led by people of color. It all just builds on each other. That makes more and more barriers to accessing capital. So I'll just put it to an example, is that an appraisal, let's just say your appraisal is $1 million. And that might be how you buy the building, but then you gotta renovate it or activate it, do all the things that you want to do to it. You can only borrow 80% of that amount, and you've got to put in 1.5. So there's a big gap in how much money you're going to have to bring to the table to be able to execute on your project. And the appraised value in a more affluent, or however you want to say it, white part of town is going to get likely a higher appraised value, and more loan money will be available to have you be able to move forward on your project. So I did not articulate that very well, but what I will say is that IFF and Propel, we don't require appraisals at all. And basically what we're looking to is what we talked about, your cash flow. Are you able to take on this debt and be able to pay it over time? And is making this investment in this capital asset helping you to do more, either serve more people, serve them better, generate more impact, expand on your mission? And if you can do that, then we at IFF will lend 95% of the project cost. Appraised value has nothing to do with it. It's, can you support the debt? So just the bias in appraisals and how that has infiltrated lending broadly really has an impact on how nonprofits and individuals, quite honestly, and businesses are able to access debt capital. So we like to shout that one from the rooftops, and we're trying to get the system to slowly change, but it really is a huge barrier to accessing capital.
Yeah, agreed. And again, I present these three as environmental problems that are much bigger than a 90-minute webinar, but these are just things that I think it's really important for us to acknowledge and for us to kind of collectively push back against. So I think now we have some time for some more Q&A. So I'm going to stop sharing slides so Dana Brito can come back and share some questions.
Sure thing. So there's at least a few questions related to capital campaigns. And so one line of the questioning is more around, what does this entail, and organizations that are embarking on it, what should they expect? And then I think there's another line of questioning around if there are any thoughts around using traditional loans versus tax-exempt bond versus new markets, just sort of thinking through the different types and sorts of capital and where they could fit in. Any thoughts or I guess warnings or experiences around that? I think people would be curious to hear as well.
Sure. So I'm definitely not a capital campaign expert. I would say, as far as borrowing money against a capital campaign, you're going to want to borrow money against pledges, not the idea of a capital campaign. If you're like, we're going to raise $1 million and we're going to borrow against that, that there's a lot of risk that that money doesn't come through, right? So if you have pledges and these pledges, you feel good about who those pledges are coming from, that feels like, okay, I'm pretty certain this money's going to come through and I'm going to be able to pay off this loan. So I think, and IFF has learned this sometimes the hard way as well, like the idea and enthusiasm around a capital campaign is the start. Then you've got to actually go out there and raise the funds. That's not easy to do. Once you have the pledges and the commitments, then you can feel pretty good about your project is underway. So most lenders are going to look, and they do it, there's all different ways of looking at it. They're going to look to see that you've raised some portion or all, or even sometimes more than the amount that you're going to borrow in pledges or commitments, and then they'll lend against that. So as far as kind of sizing how much money you can raise, there's a whole art to that, and understanding your donor base and all that. I don't know, Kate, if that's part of your technical assistance or the forum.
Not capital campaigns, but
yeah. And then I'd say, just as far as like new market tax credits and tax exempt bonds, I mean, there's so many interesting funding sources, financing sources out there. Generally for bonds and new market tax credit projects, you're looking at much larger projects, like over $5 million. And I mean, I'd say bare minimum for new market tax credits, it's 5 million. It's actually going up like more like 7 to 8 million is more the norm for it to kind of make sense to go through what I call the brain damage and cost of going through that transaction. I did see in the chat somewhere that someone said they went through it. It took a really long time. If you can get through it all to the end, it's a fantastic product. And that's a whole nother 90-minute or 3-day seminar is new market tax credits, but there's subsidies. So there's some free money that comes with it, but it's very complex, very nuanced. It's very competitive. So it would not be something to think of as like, oh, I can get a loan or new market tax credits.
Yeah, and all of these are, just kind of that simple bullet point on the side that said, try and make sure that your loan structure matches the loan purpose. None of this is an either or. There's not a kind of a traditional loan is not better or worse than a new market tax credit or tax exempt bonds or PRIs. It's really a matter of what's a fit. And particularly if anyone is participating here who works in affordable housing development, who works in community development, who is actually a nonprofit lender like IFF and Propel, we use debt, affordable housing development, CDFIs, we use debt in all kinds of ways, but that's very specific to our business. Affordable housing uses tax credits all the time. Building projects, especially in low-income communities, use new market tax credits. It's very much based on the purpose of the project determines the structure to use. And often there's multiple structures for those larger projects. When I'm thinking just about kind of, not just, but about kind of the majority of nonprofits that are operating their organization, they're generating the multiple kinds of revenue, they're delivering their services, and they're trying to maintain stability, flexibility, and adaptability. That's where these kinds of lines of credit, bridge loans, facility loans are really come in useful.
So we're actually getting a lot of questions too, particularly for people who are outside of Minnesota or the Midwest area. They want to know like where are the IFFs and the Propels of the world, and especially a lot of the innovative type of financing options that we were talking about, and combining that with some type of technical assistance to help, usher organizations through this process. Any and all thoughts, especially outside of the Midwest area, I think people would be eager to hear.
Yeah, if it's not in the chat, the CDF5 fund is, and OFN is our kind of membership organization. There is like a CDF5 fund, a CDF5 finder, and I think there's like 1,000 CDFIs across the country. And again, some of them, not all of them focus on nonprofits, but there is a way to like put in your what you do and where you're located, and it kind of spits out some potential CDFIs to reach out to. So we can definitely get that linked to y'all.
And I saw that someone had put in to either the chat or the Q&A information about Nonprofit Finance Fund, which is also a CDFI. They're based in New York, but they have some national operations that do a lot of some very similar activities to what IFF and Propel do. And there are, so look at using that CDFI finder is helpful. Talking to other foundation or other nonprofits is useful. Talking to foundations, especially locally based foundations. And I will not in any way disparage the large banks, but I will say community banks and regional banks are really great to have conversations with. And I saw somebody talked about Amalgamated Bank, which is a very much a socially driven bank, mission driven bank. And a regional bank, yep. So.
And there are actually what are CDFI banks as well.
Yep, there are.
So, so there are options, and it's actually amazing considering how old this industry is, how unwell known it is. So
yeah, and I see somebody put the OFN. OFN is the Opportunity Finance Network. It's the national organization for kind of the trade association for CDFIs. They also have a locator for CDFIs. So other questions, Dana?
Yeah, so there were a couple of questions related to debt and restrictions on debt. And I think Dana Lieberman, mentioned a little bit of this, but I think it might be helpful just to expand a little bit more on the types of, again, some of those covenants and restrictions that nonprofits will most likely encounter when they're accessing debt. And also a little bit of chatter around restricted funding and how organizations sometimes use this maybe in a not so kosher way to fund certain things. So any and all thoughts on both of those things I think would be helpful.
Well, covenants can range. They can be very restrictive and very punitive, or they could be pretty loose. But one thing to know is that when you are signing your loan document and whatever those things that say in there, this is what you're agreeing to do and agreeing to report on. So it could be that you have a certain liquidity, like 90 days cash on hand or 30 days cash on hand. It could be that you have a certain debt to surplus. It could be that you have a minimum debt service coverage. So there's all different types of potential financial covenants, and as well as other, like your management won't change or your mission won't change, all those things. So some of it, these are what if you don't meet one of those requirements, it's what would be called a technical default, but you really are in default of the agreement that you made with your lender. So it is something to be taken quite seriously and to really understand, can I feel good about making this commitment that I will always have 1.25 times debt service coverage, right? But also it speaks to how important it is to be in relationship with your lender. If your lender only sees you as a financial statement and a calculation, then it's just checking boxes. If you can go and talk to them and be like, well, the state shut down this month and they didn't pass a budget, and so they haven't been able to pay me on my contract that I'm owed. That's why my liquidity is down or my debt service coverage is down. Then they'll probably waive that. But if it's somebody who you've never spoken to before and they don't know you and have some confidence in you, it'll be a lot harder. Kate, I know you've been involved in those types of.
Yeah, but I'm also thinking that was just a real life story from an Illinois-based organization. Yes.
Yes.
And I just wanted to say that my experience too, not in my organization where I'm on an ED, but I am on the board of an organization that just experienced that. And that is exactly what happened. They were in constant communication with the lender, and they had some really good conversations. And so when in 1 year, we didn't meet that debt covenant service ratio, it was all fine, everybody is good, and they're going forward. So just the advice works in real life.
Yeah, back to the no surprises rule. Yep, right, yeah. Well, and this is also one of the probably the most common covenants or requirements are regular financial reports, whether or not that's annual or quarterly or semi-annual. But the most important expectation is that you make your payments on time or you communicate. And, obviously in 2020, when everything went up in the air, A lot of both banks and CDFIs deferred payments and did all of that. So that attention to what was happening in the world, but to be in communication. I will take this moment just to say, as we will afterwards be sending you all the slides, the recording to this webinar, and then a link to a resource page that has some of these resources, some of these tools. Dana Lieberman mentioned some great resources that IFF has about lending terms, real estate terms. We'll send you all of that. But we're also really interested to know from you, as we are building the Nonprofit Financial Commons, what are your suggestions about events we should have, resources we should develop? I'm already hearing some interest potentially in, I'm imagining, can we compile a list of CDFIs that work with nonprofits and some things like that? This is what we are building the Financial Commons so that we can be responsive to what you are looking for, what kind of conversations you might like to have. I know the moderators are interested in potentially keeping some of these conversations going among some of you who may want to then continue to have some of these conversations about using some debt tools, some other kind of financial management tools, and understanding all of this. A crash course in underwriting. I just saw man, now you're talking, oof, that just sounds like the most fun thing in the world. And that was not sarcastic. So, anything else, Dana?
I don't think so. I mean, looking
Okay,
at the
good.
questions, I mean, these are questions that we
Yeah.
talk about with nonprofits every day. I mean,
Yeah.
these are very common. And I mean, the one thing that I would just add is that, to the extent possible, it's really great to build relationship with a lender before you need the money tomorrow, right? This can't always be the case, Martin, we know that, right? But to the extent that you are in relationship beforehand and like you're talking and they're kind of on the ride with you, that's really helpful and feels less stressful, I'd say.
But we were in relationship with Propel's predecessor organization, so they helped us plug into a lender that they had a relationship with, and that absolutely still holds.
I do want to address the using restricted funds question, though, in terms of cash flow, because I think that's really important. When we, this is of course one of the characteristics of nonprofits, is that sometimes you have cash that you really shouldn't use because it's restricted for a specific purpose. And when you are managing your cash flow, kind of the ideal situation for all of us is to have sufficient internal cash flow that we have built in, unrestricted from surpluses over time, that we can kind of weather these cash flow ups and downs ourselves, just from our own cash. Having a line of credit is kind of a backup to that. Using restricted funds, and it is just a reality. It's not something we would ever encourage. I would always recommend against it. And yet it is something that you do, and that some organizations do. And it's just that there's a very serious risk there. And in a way, if you want to weigh the risk between the cost of having a line of credit and the cost and the risk of using restricted funds, I would say the line of credit has less risk. So that's one of the things to think about.
Can I add quick, Kate, on cash flow and restricted funds?
Yeah.
Your cash flow sheet should have in the revenue line a section for releases from restriction, because that's the way that you get to recognize in your cash flow that you are spending restricted dollars on the things they're supposed to be spent on, and that it's not just parked in a separate account or in a separate accounting gimmick. And like, you get to use that, you just have to use it for the right stuff. And if you can include that in your cash flow, then you're not missing out on those dollars as you're doing your forecasts.
I'm signing you up as a guest speaker on our next cash flow webinar, Martin. That was beautiful. No, I mean, of course, but it's true. Really being cognizant of that is really important in managing cash flow. This is great, and I see that we are right at time. So I thank all of you so much for your time. I thank you for participating, for your great questions. We capture all of these questions, And the moderators will look for how we build on this. We'll take all of this into consideration for future events. And thank you for kind of being part of creating the Nonprofit Financial Commons. So thank you all so much for being here.